And we're joined now by Gaius King, who is the resource analyst at Fox-Davies Capital. Okay, finally, it's Gaius King, an experienced resources analyst from Fox-Davies. As you can see from this chart, showing the price of lithium carbonate, the lithium price has been steadily growing for 3 years and peaked in November, but now it's falling. What goes up must come down. Gaius has taken an overview of the global demand for battery cars for us, and is going to talk us through the demand for battery EVs versus hybrids, what this means for lithium demand, and where it's going to all come from. Welcome, Gaius. I'm sure we're all absolutely fascinated to hear your views on this. Are you there, Gaius?
Yeah, I am, Donald. Thank you for your kind introduction.
No, I'm thoroughly looking forward to this. You may be last, but you're far from least, Gaius.
I hope so. Look,
no pressure.
That's right, no pressure. What I've tried to do is make this sort of quick, and we'll try and cover as much material as we can in the shortest period of time. So if do people see my first page?
Yes, we do. Don't you worry about that, guys.
Okay. So obviously this is the trends and growth and adoption of EVs globally. That's the main driver of lithium and where lithium demand is going to go. So if we go back to page 2, obviously that is what everyone's concentrating at the moment. Oh dear, the lithium price has fallen out of bed. The reasons why that has occurred is a bit nebulous. No one really knows. Qatar have done some recent negotiations that have been at discounts. China always bought their lithium at a 20 to 30% discount to the Koreans and the Japanese. And we believe it's a temporary measure. So if we go to page 3, this is the real reason why we're quite bullish on lithium, and more so going forward. If you look at this, obviously lithium is just coming off the top. It had a really massive run. It's got to come back. It's got to stabilize. That red line is our long-term price. We recently released a note on a company called Cleantech Lithium, which is a client of ours, and we used a long-term price of $22,000 a ton lithium carbonate equivalent, which is equivalent of about 157,000 yuan. Obviously, the current spot price is 380 odd thousand, so there's still plenty of margin left. If we go to page 4, you've probably seen these photos many times, and we would just merely say that if a technology that comes along is superior and it gives a better outcome, then adoption is very quick. And it doesn't matter whether that's refrigeration or penicillin or mobile phones or televisions. And what we have here is basically the difference between 1900 and 1913 looking along Main Street in New York. But before we can talk about lithium and vehicles that's driving it, if we go to page 5, this is one of those key projects that I love, and the diagram shows something probably surprising to many, is that car sales or vehicle sales globally are at the same level they were 18 years ago. Now in 2017, McKinsey came out and did a regression, and they suggested that by about 2030 we'd be selling roughly about 115 million cars a year. We're predicting that number will be about 30% lower at 80 million. And the reasons why that will occur, we'll jump into a little bit later. So if we go to page 6, and this just reiterates it, auto sales actually started declining 12 or 18 months globally before the recent pandemic. So the recent pandemic does not explain why vehicle sales have been falling. And it runs contrary to the grand narrative that the rise of China and India, which is very real, would bring on all these additional consumers and car sales would go through the roof. And actually at the time when McKinsey did that projection was considered very conservative. If we go to page 7, these are newly registered car sales in the UK on the left, and the EU on the right. And as you can see, in the UK, car sales actually started declining from about 2017 onwards, and on the right in the EU from about early 2018 onwards. If we go to page 8, It wasn't just the UK or the EU, it was also in China. This is before the outbreak of COVID. Chinese car sales started declining for reasons, and you have to remember the economy was running plus 7% per annum. Now, there are a lot of reasons behind the scenes, and I won't complicate the picture just yet, but it is a little bit complicated when you talk about the Chinese car market. There are some specifics associated with that. But again, in the US had very comfortable growth. Car sales were falling. If we go to page 9, please. And this is what we call the invisible megatrend, that there are the rise of technologies has allowed people to basically eschew car ownership. And that's shown with, for instance, if you look at 18 to 30-year-olds, there's 40% less young people with car licenses than there were 2 decades ago. So it's basically allowing all sorts of people to use vehicles through apps, but not necessarily own them. And this is particularly important in Asia. If we'll jump into the next page, page 10, what does this page mean? On the left-hand side, what that's showing is that per vehicle in the car share scene, there are 200, on average, 210 customers per car sharing that individual car. And on the right-hand side, and this data is from Berkeley University, and I've used a projection. Unfortunately, they don't update anymore. On the right-hand side, that is growing at 50%, over 50% per annum. In Europe, it's less. For every customer with a car share provider, there's 1 car for every 100 plus customers, and it's growing at 20%, but it's not universal. If we go to page 12, in the US, there's only 25 customers per car with a car share provider, and the growth rate is, well, it was 7 or 8%, but I believe it's now around about 3 or 4%. So there are differences around the world. The US are not really interested in platforms that share vehicles. The next page, please, on page 13. But when you add up the world growth regions together, and there are other regions that I haven't included here just for keeping everything brief, we think that it'll have a negative impact on car sales between now and 2030 of 50 million vehicles as a collective. And to put that in perspective, Volkswagen and Toyota produce about 10 million vehicles each per annum. So page 14. And the large car makers have picked up on this. Toyota were actually the first one, and they started advertising a number of years ago saying, look, we are transferring car ownership to car use. So no longer do families have 2 cars parked in the driveway. You can, with their program, and Volvo and Porsche and a number of other car makers have jumped on board, where you can pay for a subscription. You can get a SUV 1 week, you can get an open top car the following week. And yes, the price might vary a little bit. And often these programs include insurance and delivery and the whole works and maintenance. And that's where car ownership is going. Page 15. But what we're here to do is talk not necessarily about car ownership. We're talking about EVs, because EVs use lithium. And the biggest EV market in the world is China. And I've just updated these numbers recently. This is our projection to 2023. The growth rate is 21% this year. Obviously, it's been bouncing around, but the overall growth rate over the past 7 or 8 years is still averaging around about 85% compound. If we go to the next page, 16, and we look at Europe, we are still predicting substantial EV growth sales. But I have to preface that the way that these different regions report EV sales is not similar. And so we have to separate, we differentiate between battery electric vehicles, plug-in hybrids and hybrids. And the reason why we do that will become evident very soon. And if we go to the US in the next page, 17, the growth rate is the lowest among the major regions. But what is particularly interesting about the US as compared with Europe is that the US buy battery electric vehicles or internal combustion engines. They don't buy hybrids. So comparing like regions with like regions is sometimes difficult. If we go to page 18, what I've done here is I've combined all three regions, and I've assumed that that accounts for roughly around about 66% of all the vehicles sold globally. And what that's showing is that the average growth rate in those three regions collectively, weighted average calculation, is around about 70% compound per annum. Obviously, that's dropping. It was only 22% last year. And we predict that there'll be 12 million EVs sold this coming year. In page 19, what we've tried to do is say, okay, where are we at in the adoption cycle? And what we have here on the right-hand side is a sigmoidal growth curve. Now, this thing is often observed in nature, whether there be lemming growth or the adoption of Nike Air shoes or whatever. And it's a relationship that you see from different sectors and different times. And what we roughly see there is that the current shape of our growth curve there matches what they term the growth stage. But what we did, if we go to page 20, is that we've put it against a curve that smooths out the data. This is a weighted average calculation, and it appears, and if you look at 2023, and that is our projection, in-house projection, it looks like that nominal growth is declining, not in, real growth is declining, not in nominal terms. So there'll be more electric vehicles sold, but the amount of growth in electric vehicles is starting to taper. So it suggests to us that we're either in the middle of the growth stage or we're approaching maturity. If we go to page 21, now this is Europe. So whenever you talk to an analyst, you should always be aware of their own biases. And my bias is I live in Europe, and I think Europe is a little bit ahead of the curve from other parts of the world. So whatever relationships, not strictly taken, but whatever relationships I see here should be applied elsewhere, ceteris paribus. So if we go back to 1990, 10%, 12% of the Europe's vehicles were diesel, and then they made tremendous advances in diesel efficiency, and it got to a point in 2008 to about 2011, 2012, where about 50% of all the vehicles in Europe were diesels. But then, this is the interesting part, then a lot of research started coming out suggesting that actually diesels weren't great for the environment. Now, none of the governments moved against diesels, but people made the choice not to buy diesel vehicles anymore. And at the beginning of 2014, as you can see in those two blue colors, the dark blue is the hybrids, and what I call BEVs is battery electric vehicles, full electric vehicles. That's when the growth occurred. And you can see here that that growth is, almost exponential at a certain point, to the point there we were predicting this year that 53% of all vehicles sold in Europe will be battery electric vehicles. If we go to page 22. So how does this relate to lithium? Well, to generate a lithium demand into the future, we have to know how much lithium has been consumed in electric vehicles. And I'll demonstrate why that is the case in a little bit further. Page 23. Okay, so what we have here is some hard numbers. And what we've done is generated some tables. But obviously, I'm not demonstrating because that would bore you to tears, bored me to tears generating it in the first place. And basically, we split off the low-end battery types and some of these very high-end fast battery cars. And the average for a battery electric vehicle we found was around about 39 kilowatts. And a plug-in electric vehicle has about 25% of the battery of a battery electric vehicle. And then according to our collation of numbers, for a hybrid, it's about 5 kilowatt hours. So if we go to page 24, just to demonstrate what a massive effect it is. It's not good enough to know how many cars are going to be sold in the future. You also have to try and at least attempt to forecast how many types of electric vehicles are going to be sold in the future and what types they will be. So in the first scenario I've just highlighted here, and this just goes to demonstrate how high demand for a lithium could be. if 2.2 million vehicles sold in the UK were battery electric vehicles, it would account for 58% of all the world's current lithium consumption. One country, just its annual sales. And obviously our sales are only a fraction of what the world is. 2.2, it's, I think last year was about 62 or 63 million vehicles were sold. And the second scenario, it's a mixture, bit of battery electric, hybrids, and plug-in hybrids. It would be 19,000. And then if we just assume that all the vehicles in the UK were hybrids, it would only be 8,000. So there is a 640% variance just in the type of electric vehicles sold before you get into the number of cars sold. So if we go to page 25, so why is batteries important? Well, this diagram, hopefully it's easy to understand. I've reworked it a little bit. Up until 2014, and you can see in 2014, 28% of all the lithium consumed globally went into batteries. That was primarily 1.5 to 2.7 volt batteries going into things like calculators, that were mostly disposable, into computers and whatever. From 2015 onwards, that's when the electric car revolution occurred. And the vast majority, we're predicting in, well, last year, 80% of all the world's lithium was consumed in batteries. The vast majority of that was into electric cars. So electric cars very much define how much lithium goes forward. So the lithium market is an EV market. And we use this model not only for lithium, but also for rare earths. So we have a vehicle demand model of which then we drive our commodity forecasts coming from that. Can I also say one point here is that every other segment, including glass and ceramics and lubricants, every segment using lithium has been growing all the time. So it's not just that everything's going into battery electric vehicles. Every segment is using more lithium. If we go to the next page, please. And just to show this, demonstrate the difference between a 20,000 tonne per annum lithium carbonate operation. Cleantech released, I think they'll go in the Verde scoping study suggesting that amount. So for one mine, it would either supply 145,000 electric cars, battery electric cars, or 1.1 million hybrids. What we have to do is determine how many of each and what proportion will be likely to occur. So if we go to page 27, what do we know? Just to recap, I know I'm rushing through this, but I don't want to bore you. What do we know so far? We know that car sharing is a major force, and it's forcing the number of sales globally to decline. We're probably at that plateau now, and we're expecting it to continue to grow for the rest of the decade. But it is a transition from car ownership to car use. We know that growth is reasonably predictable. I've just shown against an exponential growth curve. And we think that 22.6%, obviously it doesn't matter if it's 22 or 24 or whatever, but we think roughly around the mid-20s of all cars sold this year will be electric vehicles of some type, including hybrids. Next page, please, 28. So according to that sigmoidal growth pattern, we seem to be into the mid to late growth stage. And it implies that actually EV growth will taper within the next 2 or 3 years. Next page, please. So the title should need explaining here. EV adoption is a political and not an economic narrative. These are hard targets that have been set by our respective governments. We're of the opinion at Fox-Davies that these will be relegated to want to be targets. I don't think, and we won't go into it so much today, but I think they will be aspirational targets. They won't be hard and fast because the technology is just not there. Page 30. So how widespread will our battery electric revolution be? We just make the point that battery electric vehicles are constrained by chemistry, not by political will. and you can't research chemistry away. The range that battery electric vehicles have today will be the range they will be tomorrow and the day after. There will be incremental increases and the batteries will get larger, but fundamentally chemistry can only go so far. So that's part of our narrative going forward, is that it's actually hybrids that are going to be the big adopter, not battery electric vehicles per se. If we go to page 31, this looks like, on first glance, that we're fine for lithium supply going forwards. Can I just make one point that is not immediately obvious in this diagram, is that the vast majority of supply that has come online has come from existing producers, not new projects. And in fact, those existing producers are hitting a hard roof of how much they can expand from going forward. There are some hard rock producers that are yet to come online in Australia, and there are a couple of new projects going in South America, but there is a dearth of new projects going forward. Page 32, and hopefully I'm keeping on time. These numbers are from 2019. This is just showing the size of global manufacturing prowess, for want of a better term. Can I say that the US in 2011 was the world's largest manufacturer? By 2019, that was the difference between the US and China. And we expect that number next year to be about 32% of global manufacturing within China. The last peak of the British Empire in the mid-1800s was just under 50%. So that, I think that's a natural sort of level maximum that you can get to. But basically, Europe is deindustrializing very, very quickly, particularly Germany. The US is starting to, but less quickly. Next page, please. Page 33. Where is the lithium coming from? Well, lithium's found in a number of places around the world. I don't want to dwell on the point because it's tedious and boring. But basically, it's either in the lakes, salars, excuse me, or hard rocks, in particular Australia. Now, all the hard rock mining in the world has to be processed through China. The Wall Street Journal have come out with a suggestion, obviously led by governments, in particular the US. They want all of Australia's lithium to be processed in Australia, which would fundamentally shake this entire market. But the reality of that is decades off, if it at all. The amount of energy you require is critical. Energy is just key. And China has plenty of energy. It has plenty of coal. Of the 8.5 billion tons of coal to be burnt this year, 4 billion of it will be out of China, and India will be close to 1 billion. And their consumption is racing far ahead. So they've got plenty of base load cheap power, and you need that base load cheap power to have an industrial base. If you don't have that base load, your industry dies. And it's not just copper or rare earths or lithium, it's a bunch of other projects as well. If we go to page 34, and this just highlights, this is from the EU's own study. The EU's dependency on metal imports is somewhere between 75 and 100%. And 30% of those, 19 key commodities that are primarily from China, and 100% of lithium comes from elsewhere. The EU does not produce any lithium. In fact, you could almost argue that the US doesn't produce much lithium either. The vast majority of lithium is either out of Chile or Australia. Can we go to the next page, please? Page 35. And what does that mean? That means that if you control the resources, you control the means of production. And deindustrialization is rapidly occurring in Germany. Part of it is the result of the Ukrainian war, which probably won't end anytime soon. But a lot of it is down to cost, and in particular, the cost of energy. And I just included this diagram from a Twitter feed, but it just compares the cost of petrol or gasoline, as they call it in the US, between Europe and the US. And make the point that 90% of the global transportation
please?
industry is still oil-based, and that figure is not different than it was 4 decades ago. And it doesn't matter whether you go to shipping or airlines or whatever. We're still very much a carbon-based economy. If we go to the next page, please. And where will this demand of commodities come from? So what I've done here is purchasing power parity. And what that does is that strips out the weaknesses from GDP. So it more accurately reflects where your future demand for commodities will come from. So what it says is basically a latte from Bangalore will be the equivalent of a latte from, let's say, Oslo. One might cost you $1. The Oslo one might cost you $12, but purchasing power parity will basically equalize both. And what it's saying here is that in the next 6 years, from a purchasing power parity point of view, with the exception of the US, only 3 countries, Western countries, will be in the largest top 10 economies in the world. And the big ones coming up, in particular, I point out Indonesia and India there. Very large, but increasingly high-tech industries, very large manufacturing bases, and that's where the commodity growth will come from. Can we go to the next page, please?
We're running out of time, guys.
Sorry, was that Donald?
We're running out of time.
Oh, okay, I'll hurry up. Hopefully a couple more pages. This just basically shows that where our demand for lithium is going to go. I think that's a little bit high. Our estimate is a little bit lower than that. But basically, there are no lithium projects come online. There are existing projects and those under construction. But the question is, where is the lithium? But it's not just lithium, it's all the other commodities. And this is Europe, page 38. These are all these amazing gigafactories we're going to build in Europe to build these wonderful electric vehicles, of which not a single one has a primary lithium supply. Not a single one. If we go to the next page, please, number 39. And the current flaw in the analysis of this is that we expect lithium to be on the market. Actually, lithium is not traded on a secondary basis as between the primary producer and the supplier. There is an exchange been set up in Singapore. I don't think it's up and going yet, but basically it's saying if you don't have the primary source of lithium at the moment, then you have to go to China. Next page, please, to page 40. What does Europe do best? Well, Europe makes stuff. And in particular, it makes a lot of cars. And Europe has made this interesting choice of outlawing internal combustion engine cars, which they're very good at, by the way, and they're going to electric vehicles, but they don't have the source to make electric vehicles, whether it be rare earths, lithium, cobalt, none of it. They don't have any sources of resources. So if we go to page 41, please. So this is China's grand strategy. They're planning to be a major manufacturing superpower. We estimate they're around about 34% of global total at the moment and still growing. They have controlled, and in the past 15 years, they've gone out and bought out basically every lithium deposit they could globally. And the hard rock can really only be processed in China anyway, and they've personally gone out and cornered the market in a variety of commodities. If we go to the next page, please, last page. This is unfortunately the conclusion. If you don't have a resource, and if you don't, then whoever controls that resource controls your production. And lithium is very much in shortage globally. I've tried to keep this very brief. I'm sorry, I've flown through it. But that recent decline in lithium is only going to be temporary at best. Thank you.
Gaius, thank you so much indeed. Can I jump straight in and say China clearly aims to be the economic powerhouse of the 21st century. Great Britain was the powerhouse of the 19th, America the 20th, China the 21st. What are the advantages which drives China forwards?
Well, firstly, it's power. They have plenty of cheap power and space load power, but also they have a methodology. So that they've clearly although they joined the World Trade Organization, they've eschewed it and they're going down a mercantilist route. What is mercantilism? And the greatest exponent of mercantilism, and mercantilism is an old thing, it's gone from Egypt to the Venetians to the Greeks. Basically, it's finding a resource, you take it back to your home place, you value add, and then you sell that value add to someone else. So a great example would be China with silk and the Great Silk Road. Europe wanted silk, and there was incredible money to be made, and hence the reason Marco Polo hit it that way and the whole works. Britain perfected it. What they did is they had a bunch of colonies, and they secured resources, and they were not allowed to trade those resources.
What does that mean in the 21st century, Gaius, though? What does that mean in terms of lithium and all these other things?
Well, China owns the deposits.
And what does that mean for us in the West?
We're a bit late. In short, we're a bit late. Yeah. So, I mean, look, the thing about lithium is it can only be found in two areas. Obviously, there's South America, salars, and there's hard rock. So Australia has a lot of hard rock lithium. And if we get into real trouble, I'm sure Australia will come to the party and they'll start processing there. But there's a lot of energy, a lot of capex to build and process commodities. But commodities are geologically specific. You can't go out and find a copper deposit tomorrow if you're short of copper. Copper only occurs in certain parts around the world. So if you own those resources, and China have gone out and have purchased a number of resources globally, and they control those resources. So they control the means of production.
Okay, as you mentioned, as relations deteriorate with China, security of supply becomes a more urgent matter. Can we talk through the US-Australia piece in the Wall Street Journal that you were referencing? And what does that mean in Australia? Do we actually have the capital to build these processing plants? Do we have the political will to do it? Talk us through that, if you will.
I think there is a political will. I don't know whether there's the capital, and I don't know whether there's the expertise. If we just digress a little bit, and I'll come back to it. If we look at rare earths, everyone talks about rare earths, and there's a mild panic in some quarters about rare earths. And we know where some rare earths occur. But have you seen any rare earth projects being developed? I haven't. And the part of the problem is that there's a certain level of expertise processing.
One in South Africa.
Rainbow rare earths, Palabora.
Yeah, Palabora,
yeah. Interesting, but again, it's a fairly short, it's 15, 16 years. It doesn't supply. I didn't point it out, but one of the slides in my diagram there was about wind turbines. The neodymium praseodymium of rare earths can only come from China. There are rare earth deposits in Europe. They made big announcements about rare earth deposits in Europe, but they're iron ore deposits. They have to be mined first as iron ore deposits before you liberate the rare earths. They're very, very low grade, probably never economic. And that's the same with lithium. There is no, what I haven't mentioned here is that China have gone out and bought a bunch of hard rock deposits in Africa, and we don't know what they're doing at the moment because it's off the market now and it's secrecy. But I think I know of 5 or 6 of those deposits have been currently being developed by China. Mm-hmm. But again, where are the rest of the lithium deposits to be developed?
Okay, let me take you back to the recent dip in the lithium price. Was that driven by a drop in demand from China or a more global easing in demand for battery EVs and hybrids? And you were mentioning Qatar. What do you think?
Yeah. Well, Qatar is an interesting idea. It's the world's largest lithium company. 10 years ago, it didn't exist. It was created by the Chinese state to go out and secure lithium assets. That's its primary purpose. Now it's processing, now it's making batteries. So my argument would be, and you can see with Mercedes-Benz, they're about to, many are going to transfer all their battery manufacturing to China. Mercedes-Benz are going to potentially transfer all their battery manufacturing to China, because why would China sell you the lithium carbonate when they can sell you the batteries? And at the end of the day, why then would they sell you the batteries if they couldn't sell you the electric cars? So it's it's not a, it's an ecosystem. It's an industrial ecosystem. When you lose that ecosystem, you lose the ability to do technological advancement and research because there is no economic incentive to do so.
Okay, guys, you spend your time looking at listed lithium companies.
Yep.
In terms of lithium, where should the smart money go, do you think?
Well, I've already mentioned our clients. I won't mention that again, but clean tech, we chose them for a number of reasons, and we think they're massively undervalued. Realistically, and I know all their product goes to China, but you know, there's a mineral resources. I mean, that Pilbara Minerals, I think it was gone up 3,100% in the last 6 or 7 years. Pilbara Resources went up 7,100%. Now they're already in production, they're selling into China, but you know, some up and comings are probably including Core, Liontown, Independence, IGO. They do nickel and a bunch of other things, but they picked up a deposit.
What about the projects which are underway? I mean, people like ASX Resources, I mean, there's quite a few of them. What about the Atlantic Lithium? What about the future resources?
Yeah, Atlantic Lithium is real, and they've got a big deposit, and it will get into production. I'm trying to remember the name of the company that was in the Democratic Republic of Congo. They Australian ASX, it was an AVZ or something like that. They found something really large, and this is a problem when you're in African countries, or a lot of countries. DRC are very much in China's pocket. They found a big deposit, and China have just given it to them, to the Chinese company, that is. And the Australian company, there's no recourse. So it's great to find these hard rock deposits elsewhere, but you know, China are going out purposely grabbing these resources. You know, the whole idea that we can buy and sell commodities in an open market, I think, is now fiction.
Okay, taking all that knowledge that you have and rolling it into the retail investor, what advice would you give to the retail investor? What are the strategic points for them to be looking at? How can they actually make money out of the knowledge that you have? Where are the right places for them to be putting their money? My final question.
Yep. And that's hard because it really comes down to a technical evaluation of per companies. There are plenty of lithium companies out there. Most will never get into production. The vast majority won't. And it's not dissimilar to the iron ore industry in 05 through to about 09. There were lots of iron ore companies. The ones that got in production, like you look at Fortescue Metals, you know, made 20,000% on a person's investment. So if you pick the right one, you're going to make a lot of money. It's the same applying with the lithium companies. They're still worthwhile exploring, but you have to have a global view of things. And I guess the sad, disappointing part from my perspective is that there isn't that many options here in the UK. You're going to have to look at Canada, but in particular Australians. I think the Australians are the best picks in the lithium sphere out there.
Yeah, Sigma Lithium, perhaps. Have you come across them?
Sorry, who?
Sigma in Brazil.
Yep. Yeah, again, their output, and I think that they're under a takeover offer, aren't they? Their output is not going to change the world that much. So the Australian producers are ramping up. When you look at it was a Pilbara Minerals made 800 million free cash flow in a quarter. You know, these are incredibly cash flow generative. And the thing about these hard rock producers, they're not actually producing a carbonate or lithium. They're just producing something to 5-6% and then selling it to China. But the prices are just so much larger than what they're mining it for. Can I give you an example?
No, I'm afraid I'm...
No, all right, sorry. You have to stop me because I won't stop.
I'm going to have to stop you. We're 10 minutes over.
Sorry,
okay.
apologise.
You've been a complete star, Gaius. Thank you so much for joining us. That was Gaius King, resource analyst, Fox-Davies Capital, to discuss lithium, EV batteries and all else.